Hey all, we're going to do question 4 of the MAAF119 main exam. So skipping ahead to the question, as usual, part A, we are required to calculate cost of equity using CAPM, the capitalizing pricing model. Then calculate weighted average cost of capital, WACC, explain why the restructure occurred, and why the restructure has caused WACC to change, and advise whether Marie's offer should be accepted. Okay, so straight away we know that this is to do with investment decisions, which has the calculation of the cost of capital, which is a combination of equity and debt. And then there's methods for calculating the cost of equity and the cost of debt and so forth. So the cost of equity, there's a few different models. The CAPM, the capital asset pricing model, is one of those. Fortunately, the exam specifically says we need to use the CAPM model, so we need to have that formula ready to go. So let's quickly read the background to this question. So they've got a manufacturer called APC. So Anastasia owns 100% of the company, 3,000 shares, recent valuation 3 mil. They owe 5.7 mil in debt. 2 mil of this is due to be repaid in 1 month. The remaining balance is due to be paid in 2 years' time. So the equity beta is 1.6, risk-free rate is 1%, average rate of all ordinary shares listed on the New Zealand Stock Exchange 7%, weighted average WACC is 7.62%, company tax rate is 28%. Okay, so let's pull up the formula over here. We'll keep the question over here and we'll do the calculation off to the side over here. Okay, so first thing we need to do is pull up the CAPM formula, which we've got over here. So the cost of equity is equal to the risk-free rate plus beta bracket times the market risk premium. Okay, so first of all, our risk-free rate per the question is 1%. So let's type that in. Equals 0.01. Well, let's just do it as 1 because it's all going to be in percentages. So we'll go equals 1 plus the beta, which is 1.6, times bracket. The risk-free rate is 1%. But it should be, it should be the difference between RF minus RM. So the risk-free rate is we're at 1 plus 1.6 times bracket the market risk premium, which is calculated as RM minus RF. So RM is the market. It's the return of the market, which we can see in the question over here is 7%. So it's times 7 less the risk-free rate, which is 1%. So we'll just close that off. And then the answer should be 10.6% per that formula. Okay, so that's the answer to part 1 for before. The next thing we have to do is calculate the cost of equity after the proposed capital restructure. So that's before and after. Okay, so to calculate the impact after the capital transaction or the restructure, and what that's referring to is basically once we change the debt and equity levels, which is what we're saying here. So Marie's offering to pay $2 million of bank debt in exchange for shares, 2,000 shares to be issued to her. So that's going to change the weighted average cost of capital. So basically what we do in that situation is scroll down a little bit into your notes until you get to de-gearing and re-gearing the beta. So basically what we have to do is we have to first of all figure out what the beta is for the company if we were to remove the impact of all of the debt. Okay. Once we do that, we can then re-gear it at the new expected level of debt. So we're going to use these two steps here, de-gearing the equity beta and re-gearing the asset beta. So those are the two formulas that we're going to have to follow. And whenever you see a question that's saying before and after, whenever it says after the capital restructure, that's when you need to use these two formulas. Okay, so let's get started. So first of all, we need to calculate we need to de-gear the equity beta. So the formula for that's over here on the left. So it's the equity beta of a geared organization. So we establish that up the top. Okay, so the formula is going to be, let me just extend this across. Okay, so the beta is equal to 1.6, which is from the question, divide by, in brackets, 1, which is in the formula, plus another bracket, 1 minus TC, which is the tax rate. From the question, that's 28%, so 0.28. And then timesing that by debt over equity. So the debt currently is $5.7 million. It's up here in the question over here. So 5.7, divide that by the equity in the business. So we know that the shares have been valued recently by a chartered accountant at $3 million. So that would be the value of the equity there. So let's just put our amounts in there. And then as we can see, that the de-geared equity beta is 6.76. Okay, so the next step we have to do is actually re-gear the asset beta. Okay, so we need to follow this formula over here, which is BG equals BU. Okay, so what we need is BU, the equity beta of an so that's going to be the number up here. That's the ungeared organization. So that's the number we calculated before. So to calculate BG, we're going to go this number up here times bracket 1 plus bracket 1 minus 0.28, which is the tax rate, times debt over equity. But we need to include the debt over equity that we're expecting under the new company. So basically that's going to be the 5.7 million less the 2 million. So it's going to be the 3.7. Okay, now divide that. So the equity figure is currently 3 million, but we're expecting that to go up to 5. Okay, so let's put that in. And we're getting equals 1.036. That's the answer there for the beta. Okay, so we've got the beta. Now the final step is to go back to this original formula, the CAPM model, and to insert the calculated re-geared beta back in the formula. So we're going to go equals risk-free rate, which is 1, plus the beta, which we know is 1.036, times that by the difference between RM and RF. So it's going to be 7, which we said was the return of the stock exchange, less 1. And there we have it. 7.22% is the answer. 7.22. That's the cost of equity after restructure. So that's how you get the 4 marks there. Okay, to answer this question, to calculate the weighted average cost of capital, in the notes in chapter 12 investment decisions, there's this awesome table that I've created, which basically you fill in the yellow cells in here, and this is basically how you'd approach it in the exam. You'd fill out this table here. So what goes in here is the debt and equity amounts from the question. So starting off with the debt, and keep in mind it's the new weighted average cost of capital. So it's after Marie's paid down $2 million of the debt. So we're going to start off with 5.7 million and take away 2 million. So it's actually 5.7. Okay. 5.7. Whoops, sorry. 5.7 minus 2. So it should be 3.7 like that. And the equity is going to be the 3 million plus the 2 million that she's receiving in shares. So it's going to be 5,000. Okay. Next, this weighting automatically calculates. Next is the cost before tax, and that's basically the rate of return. So for the debt, we can see in the question that the bank would reduce the interest rate from 8.4% to 8.2%. So this number here is going to be 8.2. And equity is going to be, okay, and then for the cost of equity, we're going to put the 7.22% amount in here. 7.22. Now remember, we calculated the 7.22 from question A. That's the cost of equity using the CAPM model after the restructure. So we're flowing through that amount from before. So there's the 7.2. Tax rate's 28%. Okay, so the reason that the tax rate only applies to debt is because equity, you don't get any deductions for that. Tax, you do. It's a deductible expense. So you actually have to reduce the tax dollar amount. So the cost after tax is actually 5.9%. Equity 7.22%. Therefore, the weighted average is 2.51 for debt. Equity is 4.15. So that's basically just timesing the weighting times the cost after tax. The sum of those is 6.66, and that's basically the weighted average cost of capital. So that's how you answer B. Okay, for part C, explain why the restructure has caused the WACC to change. Well, this is just testing your understanding of how the formula is actually working. Okay. So, first of all, the WACC has been reduced. It's down to 6.66%. This is down from 7.62% in the question originally. So we need to understand what are the key drivers changing that. So first of all, the WACC is calculated like this. So it's the average of the debt and equity. So what's changed is after tax interest rate basically has changed. So one element is the interest rate has actually changed from 8.4% to 8.2%, which of course would reduce that amount, which would of course reduce that amount. Okay, and then the second thing that's going to have changed is the cost of equity, and that's basically what we assessed in the first question. So previously the beta was 10.6, afterwards it was 7.2. What this means is there's reduced risk because there's a lower level of gearing, a lower level of debt in the business. So those are the two drivers. Just to recap, number one is a lower rate of interest on the debt. Number two is a reduced cost of equity because there's less debt in the business. That's how you answer C. Finally, for part D, we need to figure out whether or not Anastasia should actually accept Marie's offer. So the considerations we need to take into account. Okay, well, first of all, the WACC has decreased from 7.6 to 6.66%. Okay, this is making her overall funding position cheaper. So that's one argument to say that she should accept it. Okay, now, secondly, that lower WACC actually increases the value of shares. The reason for that is the value of shares are calculated based on future cash flow, so dividends paid out. However, when we do that, we also need to take into account the net present value of all those future cash flows. So if there's a cash flow received in 100 years, we need to discount it to today's money. So that's going to be impacted by the cost of equity. If you look in these dividend valuation formulas, which are in the same chapter, a little bit further down in the notes, you can see that the value is equal to the expected future annual dividend divided by the cost of equity. So if we do a quick sum in our calculator and say 1 divided by a really small number, because we're actually reducing our equity, look what happens. We're going to get a really big number. So reducing our WACC increases the value of our shares. So a third point as to why the offer should be accepted. Now keep in mind you probably only need 2 to justify the 2 marks is that, well, Marie's going to pay down $2 million of debt, and the new shares should cover that. So potentially another reason is just getting that debt level down. And finally, even with the new shares issued of 3,000, Anastasia is still going to hold a majority in the company. So generally people are okay issuing more shares as long as they still hold control in the company. That's the case here. She's got 3,000 shares total. She's going to issue 2,000, so she's still going to hold a majority in the company. And that's how you get full marks on question 4, part A. So let's move on to part B. So it's still part of the same question. So it's 1 year after the restructure. Anastasia's asked you to value the business. Okay, so let's skip ahead to the question. Calculate the enterprise value of APC using an income-based approach. Okay, so to calculate enterprise value using free cash flow, this is the approach. So we look at free cash flow. We figure out if it's a perpetual period that we're looking at or a fixed term period. I think generally for the MAAF module, we're looking at perpetual cash flows. We then apply the formula using WACC. So we need to know what the WACC amount is. We plug that in the formula and we calculate enterprise value. That's basically the whole value of the business before you consider debt and cash. And after that, you adjust for debt. And that gets you to your equity value. We only need to stop here at enterprise value for this question. But we do need to know the formula. So as I mentioned before, we need to figure out, are we looking at perpetual period? So every future cash flow for the rest of all time. Or do we look at a fixed term? In this case, it's perpetual because we're saying they've given us 1 base year and then they've given us perpetual growth, basically. Actually, sorry, it's not perpetual. They've given us 1 year of cash flow. They've told us to grow it out at 5% for the following 2 years, so up to year 3. And then after 3 years, APC's cash flow is forecast to grow at 1.5% per annum. So it is perpetual, but we need to calculate what the cash flow is in the first 3 years so we can figure out what the final growth rate is going to be. So the way we're going to do that is we're going to build up a table. We can just do that over to the side over here. So we need to know what year 1, year 2, year 3 growth rate is, and then after that we can apply a perpetual 1.5% growth rate using the formula. So first of all, our free cash flow is 603,820 in year 1. That's going to grow to 1.05 in year 2, and then that's going to grow to 665,712 in year 3. Okay. After year 3, it's going to go at 1.5% into perpetuity. Okay, so we're going to plug this number in the formula now. We're going to add the growth rate of 1.5%. So let's have a look. So the formula is equal to the free cash flow. So that's going to be equal to that number there. And then we're going to times that by 1 plus the growth rate, which is 0.015. Have I got that right? And then we're going to divide that by WACC minus growth. So it's going to be 6% is the WACC, because we've got that in the question over here. So 6% minus 1%. Just want to make sure I've put that in the right number format in the calculator, because when you're dealing with percentages and numbers. So let me just have a quick look. So it's the 65712 times the 110. Let me just make sure I've got this right. 1015. Just be really careful on the exam. Just double check everything. Divide by 6. Oh, and that 1% should actually be 1.5%. Sorry, not 1%. So let's have a look. 15,01494. Okay, cool. So that's how we calculate the enterprise value using an income-based approach. Then for part B, outline 2 concerns that a purchaser might have if considering purchasing APC's shareholding, noting that it should not include the accuracy of the valuation. Okay, so I guess the first thing that immediately jumps to my mind is the debt amount that we purchased, that comes with the business. Because as I mentioned before, this free cash flow approach only takes us to enterprise value. To get to equity value, you also need to take into account debt. And equity value is the value that a company trades at, say, on what you'd pay on the stock market, for example. And the reason we adjust for that is because every company's got a slightly different situation. There might be 2 identical companies, but one has $10 million in debt and the other one has $0 in debt. Obviously, the one with $10 million in debt must be less valuable than the one that has no debt. So that's the first large consideration, is that there is a large amount of debt in the business, $3.7 million left over, which will need to be repaid. Especially, I think, in the question we said that the balance is due to be repaid in 2 years' time. So it's due in a relatively short period of time. And probably the only other element is just Anastasia. So if she's selling her shares, is she staying on the business? How much of the business actually rests with her? How much of that is specialty knowledge? So that generally there's some sort of earn-out agreement where the seller stays on a little bit longer to help mitigate that risk, but it would be a big concern for the purchaser. Okay, so for part C, which it says here, part C is not related to parts A and part B. It looks like it's an ethics question, and it's worth 4 marks. Okay, so for the final part C, we've been asked to respond to each of the 4 events, ensuring that we do not breach the code of ethics. Okay, so first of all, we're dealing with a petrol station, and we've been engaged to do a valuation for the business. Okay, so we need to respond to each of these 4 facts so that we don't breach ethics. So number 1, we've been offered to be paid 5% of the valuation amount. So the first thing that comes to mind is that where's your incentive? Because if your incentives are to drive the growth of the business, then you may be persuaded not to have an objective view of the business, but rather to inflate this purchase price. So a more appropriate remuneration agreement would be a time-based agreement rather than based on amount tied to the purchase price. So number 2, we've been informed by the seller that there's a $50,000 repair requirement. He asked us not to include this in valuation. Well, we need to take this into account into the valuation. The reason is otherwise it wouldn't be ethical to deliberately hide that when it would objectively impact the valuation of the business. So number 3, so when we're doing the valuation, recent research indicates that the pay at the pump, which is being rolled out, drops revenue convenience stores associated with it between 10 and 15%. So Sam, the seller, accepts that we need to take this into account when forecasting the income of the convenience store. He's requested we don't mention this in the valuation report. So it is important that we disclose all material assumptions in our valuation report. And finally, number 4, a potential buyer has approached us and asked if there's anything that Sam might have revealed to you about the business that is not reflected in the valuation. So your first response might be to say, this is probably only a tricky one. Your first response might be to say to them, yes, there are some hidden things in there. However, that's not actually the case. Because as long as we've satisfied all of our requirements in the above steps, so we've acted objectively, we've disclosed all material assumptions, and everything is fair and reasonable, it's actually not ethical to disclose any information other than that because of confidentiality. These guys could be potential competitors. There could be personal information in there. Generally, any request for information should be gone through Sam, the seller, and generally there'd be an NDA or some other confidentiality agreement, but confidentiality should always be at the forefront of your consideration before you're revealing information. So there's probably a trick question. And that's it. That's how you get full marks on question 4 of the MAAF exam, and that's the end of the exam as well.